and welcome to Investors Hangout, this fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, are you wondering where to invest to save taxes? After all, there are a lot of options available out there. So which one should you opt for? NPS, then there are tax-saving mutual funds, or the traditional PPF, NSE, or the 5-year bank fixed deposit. Which one should you opt for? So to help us with that and much more, we are joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, before we jump on to discuss the best tax-saving avenue available out there, first tell us if one should continue to make tax-saving investments for getting a deduction under Section 80C. Because, the new tax structure, which offers a lower tax slab, does not allow any such deductions. So should one still go with tax-saving investments?
My guess is that, for many people, because, we have been used to all these deductions, you can reduce your taxes by reconfiguring it. My simple take is that, for anybody who is earning less than 15 lakh rupees, for him, the old methodology, whereby you take all kind of deductions and everything, still makes sense. That still makes sense because you can get this 80C, besides many other things, which you can configure your salary to make it more tax efficient. For anybody over 15 lakh rupees, it doesn't make a difference. But at the same time, I would say that, look at the Value Research Tax Saver tool. We have just, designed a new tool where you can put all your salary structure and it will tell you which one to choose. Not only it will tell you which one to choose, it will also give you the right options, the best options for you, given your risk temperament and, your investment time frame and other things.
All right, and for someone who still follows the old tax structure and wants to invest to save taxes, which according to you is the best alternative available for him?
Broadly, if you divide or segregate the tax options, one is that you have the fixed income avenues, the Employee Provident Fund, the PPF, the National Savings Certificate, the bank fixed deposit. On the other extreme is this ELSS, the tax saving scheme, and in between, I'm talking of all the investment avenues, not the spending avenues, because even the tuition fee and other things, there are a lot of expenditure which are eligible 80C, under 80C. I'm not referring to that, but only the investment avenues. In between, there are, hybrid options. For example, the insurance policy, investment linked insurance, or there could be a pension plan which can have a fixed income, equity or debt, or the NPS to an extent is a hybrid because the maximum equity you can have is 75%, remaining 25% has to be fixed income. For government employees, it has to be even lower, only 15-20%, because that is the mandatory contribution that you make. So not getting into the complication, I think, most people in India, they don't have any equity exposure, and very small percentage of our population actually invests in equity. And whenever they invest the wrong way, for the wrong reason, and they invest at the wrong time. And that is what we have historically witnessed. The beauty of the tax saving investment by way of this tax saving fund is that you invest in equity, which for many people is the only equity investment possible. Nowadays, it makes so much more sense because all other fixed income avenues, the interest rates are coming down, and they have come down to a level where you just might feel happy that you are making money, you are generating some return, but actually you are losing money. Because if you deduct the inflation out of the return that you generate, it will be negative. And also, mind you, this is the inflation we are referring to, which the government calculates, the wholesale price index, consumer price index, which is an index. That is not your inflation. Your inflation is how much did the price go up of the consumption basket, your consumption basket. How much were you investing last month? How much were you investing last year, this month? That is your inflation. And if your expenses went up, that is your inflation. Take a look at that. That is, and if your investments are not generating as much, then in fact that is also not the right yardstick to measure, because you have to see that okay, this year, this month you spend this much to make a living, and how much are you likely to make, spend next year, this month, this month next year, to really understand your inflation rate. And that can change radically, that can change on your configuration and other things. But without getting into that, the point I'm trying to make is that the return that you get on your fixed income avenues is nothing. So might as well take some chances. And when you take some chances, it is important to get used to in the right manner. And tax saving funds are a great way to actually start in the right manner, because you invest and you get stuck for 3 years. You end up doing well. The real problem is that when people invest with huge expectation and they are not able to stick around, because when they invest and they see a 5% decline, they run away. They run away never to come back again. And all their money keeps earning very low return all their life. So that is why most Indians are not equity investors. And this is I think, I would look at it more in terms of getting used to acclimatizing yourself to equity investments. And there is no better learning, there is no better, coaching, training than experiencing it. Because as I keep saying, that no amount of lecture in terms of appreciating risk helps you till you really experience it, and that's the wrong experience people end up getting. So the key point is that fixed income will not get you anything meaningful. The hybrids will actually not take you anywhere. You will not get meaningful of insurance, investment, or anything. And this is something where you get stuck. And if you get stuck, might as well think a little longer than beyond 3 years. And I think it will be more than the return. It is more, the training and the experience will be far more valuable and rewarding. So get going with ELSS.
So ELSS is the best tax-saving alternative, is what you're saying. Now, if someone has a little more than 1.5 lakh rupees to invest every year, where should he do that? Where should he invest that?
First and foremost, I find that many people start their investment planning with the tax as a trigger point. One should be investing and saving anyway for the long term. But more importantly, the specific question that what beyond 1.5 lakh, of course, ATC limit is 1.5 lakh. So if you have the opportunity and the ability to save 1.5 lakh rupees a year, then invest in ELSS. And beyond that, there is another 50,000 rupees window available, which can be invested in NPS. And that, I think, is the second best thing. Tax save is money earned. Your ability to deduct, income, which can be subtracted from your, income, which can be subtracted for computing taxes. Another 50,000 can be done, and that is in NPS.
So everyone who thinks that 1.5 limit is a little, is exhausted, and it's not a substantial amount. You can still save 50,000 rupees more by investing in NPS. Okay. Then what about NPS Tier 2 accounts? They also offer a deduction for the taxable income, and they also have a lock-in period of 3 years, I believe. So.
Yeah, that is not for masses. That is only for central government employees, and that is something which has been made, which has been enabled recently. And I think, that's not meant for masses. It's only for the... So the universe itself is very small.
All right. Time now to move on to our viewers' questions. And the first one has come in from Tapash Mukherjee. He says he's superannuated in 2020 and he's still investing in Public Provident Fund. He doesn't want to invest the entire amount in mutual funds, he says, and hence continues to invest the maximum possible amount in PPF. So every year after his investments in Senior Citizen Savings Scheme and the Post Office Monthly Income Scheme, he is still investing in PPF. So Tapash wants to know if he's right in doing so.
I don't know. Somebody who is superannuated and is still able to invest, good news, which means that he has some other investment avenues, some other income avenue. But I would say that, if somebody in his retirement is able to earn and save this much, that he's able to exhaust his, ATC and still able to make a living. He can do, what he's doing is the most risk-averse thing that one can do. You are not taking chances with your money. Your money in Senior Citizen Savings Scheme in Public Provident Fund is sheltered by the sovereign guarantee. These investments will fail if India as a country fails. Till India remains, this thing will work. Then comes, Post Office MIS is also of the same category. I think, one should take little chances. If you have if you have nominees, if you want to leave a larger state for your children or your successors, because most people don't understand that, this is the risk lies in actually thinking short term. Equity is very risky if you are thinking for 3 months. Equity is very risky if you are investing for 3 years. If you are investing for 10 years, 15 years, if somebody would have invested on any 10-year period in the Sensex, of course it was not an investment avenue available, but Sensex was framed in 1979. And if you would have invested on the worst of day and took your money out on the worst of day for a 10-year period, the likelihood of losing money was zero. The likelihood of losing money was zero if you held it for little over 7 years. So if your money is likely to remain invested forever, which looks like it will be, because even in your retirement you are not requiring money for consumption, then it's money forever. Then leave a larger state, and the equity risk gets reduced or gets eliminated with such time frame. So keep that in mind. The risk lies in having a short time frame.
So Tapash, you say that you don't want to invest entire amount in mutual funds, but you must start allocating some.
I would say meaningful amount in mutual fund, given that what I'm able to understand about his financial configuration, that he does not require income from his investment even in retirement, and rather he has substantial income in his retirement.
All right, now Raghavendra Harirao asks, what are the tax-saving investment options available for a senior citizen? Also, he wants to know your opinion about pension schemes by LIC.
All the standard tax-saving avenues available to anybody, any citizen, is available to senior citizens as well. Of course, senior citizen crossing 75 years of age, they have, their limit goes up and all that. So that is a special privilege. Besides this, you have the senior citizen savings scheme and post office, scheme offered by LIC. These are two specific schemes available for people who are over 60 years of age. So that's it. But they're nothing special. They are fixed income yielding, and of course it is based on the understanding that people who retire, they become completely risk averse. But that may not be the case. You just we come across some examples of investors who post retirement, they don't need their money, and their money can still be invested for the long term. Yeah. So two special schemes available for senior citizen. One is the senior citizen savings scheme, where the maximum investment can be 15 lakh rupees, and only the 1.5 lakh rupees annual investment will be eligible for ATC deduction. Besides that, 10 lakh rupee, this is a special scheme available only for senior citizen, Pradhan Mantri Vyay Vandana Yojana, or managed by LIC, where you can invest up to 10 lakh rupees and derive the income. But these are not, I'm not sure about the tax, efficiency of it, but this is something which is yielding you decent return as compared to other fixed income avenues.
Okay, now Padamdev Lau asks, one can easily assess the performance of dividend plans of mutual fund schemes by looking at the declared dividends over the past years. He wants to know, how should one assess the performance in growth plans?
Oh, he has got it all wrong. What is wrong in this way of measuring that if your fund is giving dividend, it is doing well? This is a wrong yardstick, because your fund could be doing, might be giving dividend, but it might be doing very poorly. And so the only way of measuring accurately how your fund is doing is looking at the performance, which means at any time period. One is that measuring your performance when you invested, and what is the worth today, and how much dividend you got in between, and what is the worth of that, because there could be periodic dividend, whether you are getting a dividend on a month-on-month basis, on a quarterly basis, on an annual basis, or sometime you don't get it. So there is a cash flow to it, and as a result of which, what is the return? So based on your dividend, it is not. You just get an impression that your investment is doing well. Come to Value Research Online, type the name of any fund, and look at the performance tab, where you get 3 months, 1 year, 3 year, 5 year, 10 year, 20 year return of every fund. Then you also get the relative performance. What is the return of similar kind of funds, the average of similar kind of funds, which is the category average. Then you get another line, which is the benchmark. the most relevant benchmark for that category, how much it has given. So, for example, if you are comparing a large cap fund with the benchmark will be a Sensex or a Nifty. So, if you would have done nothing, if you would have just chosen an index fund, how much would the return will be, and how much return is from this fund. So, this is the way to measure it, not dividend.
Or he also asked, how should one assess the performance in growth plans?
Oh, what I'm saying is that, you should be looking at the dividend plan or the growth plan based on this only. And at Value Research, the calculation of return of the dividend plan, there are two ways in which you can look at the return. One is that, look at the fund and go to the specific fund fact sheet and go to the page and you get this return. But the most precise way of measuring, if you have already invested in a fund, is if you're maintaining your portfolio at Value Research Portfolio Manager, My Investments, is that you invested on a given day, then you invested some more on a given day, then invested some other time period. It could be by way of SIP or some periodic investment, or you took some money out on specific dates, then you got some dividend in between. By the result of this cash flow, you invested on many occasions and you got your dividend on many occasions, or you redeemed a part of your investment on many occasions. The result of this translating into percentage return per annum, that is what you get on the Value Research My Investment Portfolio Manager. And that is something which you should look at. That is the most precise way of looking at it. If you are trying to get an impression of it, which is then I think the best impression that you get on Value Research Online is a rolling return, which is an average of a certain, say, 1 year rolling return will mean that we will be calculating the 1 year return every day for the last 1 year and doing an average of it. So, what is the likelihood of earning that return? Because otherwise, 1 year return will be, as of today, will be 1 year ago you invested 100 rupee, and what is the worth of that 100 rupee today? So, this is a very simple calculation. Rolling return will be calculating 1 year return for the last 1 year. So 365 readings, or as many readings in the past 1 year, 250 days or whatever, and as a result of which, and doing an average of that. So what is the likelihood of that? Because this is all past, and that is a better indication of what is the likelihood of what anybody would have likely earned if you would have invested on any average day during the year.
Okay. Now, the next question has been sent in by 41-year-old Ravish Malhotra. He received 9 lakh rupees as gratuity after he quit his job and joined another place. So, how and where should he invest this money? He's already investing 25,000 rupees per month in mutual funds.
One good news is that all his money is tax-free. He is not liable to pay. This is not his income. This is the money on which he is not supposed to pay taxes. In fact, anybody earning, getting gratuity up to 20 lakh rupee. Earlier, the ceiling was 10 lakh rupee. The government has been very generous, and now this limit has been increased to 20 lakh rupees. So, if you get any amount up to 20 lakh rupees, it is tax-free. The other is that, I'm not the best person to actually answer it. He himself is. Because it is entirely a matter of when is he likely to need the money and what his experience with investment has been. If you are going to be investing for the first time and you are not likely to need this money for next 5, 7 years, 10 years, then I would say that start with an aggressive hybrid fund or a balanced advantage fund. If you are experienced with your investments, then maybe invest in a flexi cap fund. Flexi cap fund, but should you invest at one go? Never. When investing in equity, you should always spread your money over time. Be gradual about it. So spread your investments over the next 12 months, maybe 18 months, because it's a very important money. And this is resulting from working for many years. This is effectively, so long-term money, invest in equity or hybrid, depending on your experience. If you are likely to need this money in next 2 years time, 3 years time for some specific or important goal, then put it in fixed income, a short-term bond fund only.
All right, now Ankit Jain asks, what kind of mutual funds would you suggest for someone's long-term debt allocation?
Two kinds. One is that if you're a completely risk-averse person, then look no further than short-term bond fund. But if you are willing to take some chances, or you are not getting greatly concerned. You want, you're a conservative investor. You don't want to invest in equity substantially, and you want to generate reasonable return, and you don't want to take extraordinary risk. Then maybe consider a conservative hybrid fund. These funds invest up to 15-20% into equity, remaining in fixed income. And my sense is that your long-term investment will not be at risk of the equity markets wildness, the wild movement of the equity market. And I think the likelihood of beating inflation better with 5-7 years time frame is very high with very low risk.
Umang Gildial wants to know how important are rolling returns to decide if one should continue investing in a particular mutual fund scheme. Also, what other factors should one look at while making this decision?
One is that rolling return is a better indication of the likelihood of getting that return. When we look at 1 year return, or when we look at 3 year return, the trailing 1 year or 3 year is very heavily dependent on the state of the market 3 years ago, or the state of market now, or the state of market 1 year ago, and the state of market today. Say for example, we were looking at the returns in the month of March or in the month of April. Every fund's return was looking like 100% return, because the market went down in March 2020, and from there the market jumped. But it was not taking into account the 50% decline that happened immediately before that, the preceding period. So this rolling return, as I was explaining, that it is calculating 1 year return every day for the last 365 days, or calculating 3 years return for every day, and then calculating an average out of it. So it will not be skewed by the extraordinary state of the market at the starting point or at the end point. So it is better indication. But mind you, rolling return, trailing return, or any kind of return is all past. It all depends on what happens to the market, what happens to your money after you have invested, and you don't know anything about it. All you have to do is, you have to look at the broader sense, that is the fund diversified? Has the fund been able to beat the market in a rising market? Has the fund manager been able to beat the market in a falling market, falls less? And rolling return is a better indication if you have to look at the returns. And value research stock page, you get a fund page, you get the rolling return of every fund, and you look at it graphically. So graphical representation of that is the best. Just click on the time period and you get the rolling return. And but this is all past, and you have to take chances. And I think you reduce your chances of you succeed only with your time frame.
Okay, now 75-year-old N. Krishnamurthy has some investment in mutual funds. What would be the ideal ratio between large, mid, and small caps is what he wants to know.
There isn't a thumb rule. Once again, most people, seek my guidance in terms of seeking an answer, that there is a rule somewhere which I will explain them, and that will work for them always. And there is actually no rule for many of the things which people ask for. For example, if Mr. Krishnamurthy is experienced and has been investing in the market for last 10 years, then substantial investment in small cap will also be nice, will also be fine. If he is or mid and small cap will generate superior return, and it will be fine. The only problem is that if he is not very old, and if he is not experienced, or for some reason his risk appetite, or he will get very nervous at this, if he thinks that it's very risky, he suddenly sees a decline of 20-30%, it could be very disappointing. So if he gets disappointed now, even after those experiences, I think one should keep away from that. So the right allocation is entirely a matter of being comfortable, and how much, and that comfort will not come from my specification, my prescription. It will come only from your experience. And I think more academically or more theoretically speaking, the complexion of the market is like this. The large cap account for 75-78% of the market. If I actually do a sum total of all the companies traded in the market, 75% of the companies accounts are large caps. No, top 75 companies are large cap. That if I actually look at 75% total market cap, Another 300-400 companies will be mid cap, and the bottom 1800-1900 companies will be small cap. So you will have a large number of small caps, and you will have a very small number of, but their relative ownership, or the percentage stake in the total capitalization of the market will be much less. So I think one should follow that. If you want to have a reasonable representation of the market, 60 to 75% should be in large cap. Next 15 to 25% should be in mid cap, and the remaining 10 to 15% should be in small cap. And if you don't want to do it yourself, then buy a flexi cap fund, and that will take care of it.
All right. Now, Karan asks, how should one decide the amount to be maintained in the emergency corpus? What would be the sufficient amount?
Once again, there is no thumb rule, and I'm nobody to actually answer it. You have to get your answer yourself, or you have to figure it out yourself. And I urge you to figure it out yourself. Reason is that if you have old parents, and they might require some medical attention, and you need a different scale of emergency fund. If you have young children at home, then you need a different scale. So it all depends. It also depends on how safe is your job. If you're likely to lose your job once in a while, or what is the reliability of your income. If your income is very erratic, you earn very well once in a while, and then once in a while you don't earn anything. So you need a larger emergency fund. So these are the inputs to deciding the amount, not me.
Kamal Thakur asks, where should a 72-year-old invest to earn enough for surviving without depending on his children?
Once again, I would say that I don't have the best answer, because it is also dependent on how much money you have and how much expenses you have. If you are likely to need, if you have 1 crore rupee, and if you are likely to need 50,000 rupees a month, it's okay to be able, you will be able to achieve it with I would say 70% fixed income, 30% equity allocation. Because if you take out 6%, that will be that will be about that will fulfill your need. Besides that, if your investments are generating 10% return, that 4% in higher return will translate into higher capital for you. So we will be able to increase your income every year. So that can support that rising, the need for rising income starting from 6%. If it is if it is any different, then you need to, or if you have more larger capital, then you can do with even less fixed equity. If you have smaller capital and your need for income is higher, then I think you have to take greater chances. At the same time, you'll be more vulnerable. So figure it out yourself, and you will have to assume greater risk, or you will have to reduce your income, and you'll have to do this calculation. And finally, all calculation translates into what percentage of your capital are you going to consume every year, and will your investments be able to generate a little more than that? That is the key to it. That is the principle which you have to figure out.
Right. Today's last question has been sent in by Ranganathan. He wants to know if it's safe to invest right now as the market is moving only in one direction. So how long is this uptrend likely to continue?
I wish I knew, and once again, I don't have an answer, and I don't think anybody will have an answer. A lot of people are guessing that the market is poised for a big decline, big fall anytime, and they have all been wrong in the last 1.5 years. And I think I will be also wrong if I actually, so just not to be embarrassed, I won't say anything. But all I would say is that you don't have a control on the state of the market. You don't have the control on the timing of the fall of the market. You also don't, nobody knows anything. What we know very well is that when are you likely to need the money? We also know that how nervous we get when we see a big decline in the market. If you are actually losing sleep in March 2020, not because there was a pandemic, but your investments were falling in value, then you need to figure it out yourself. How much money, what part of your money should not be in equity? Do you have the emergency fund? And in fact, if you have these variables, if you have these shock absorbers, if you have these, I would say, these preparedness around a big fall, then you will be much better placed, you will not get upset, you will not get nervous. If you have a term plan, if you have a health insurance, and if you have the emergency fund, your risk tolerance goes up, because you will not, and if you are in a stable job, the risk tolerance goes up even further. So I would say that do all those things, and after that try and arrive at some kind of allocation to fixed income, which will not go down, because that is the money. And keep changing. The equity has gone up, move a little bit of money, so you will not be behaving in a knee-jerk way. A lot of people are thinking in terms of 0 or 100 in equity. That's not the way to look at it. The way to look at it is 75% in equity, 25% in debt, and because the market has gone up over the last 1.5 year, one direction only, so that 75 would have become 85. Rebalance it to 75 again. So you will not have the regret of, if the market keeps going up. You will not have the regret that, okay, you did nothing because the market went down thereafter. So you would have done something about it, and you will benefit from that, because if you are able to move your money back in equity, if the market goes down, you will profit from it. So do that little bit, not much.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.